Thanks very much. When we started talking about this panel, we kind of decided to break it down into probably 3 different areas, the title being co-investment, taking it to the next level. Areas that we thought different themes we thought we'd break it into, sort of start off with angel syndication, angel to angel, the traditional angel to VC transition, and the potential for north-south syndications, or as our speaker at lunch said, international syndications, but we'll start with north-south. So I thought I'd kick it off getting the panelists to sort of start off with their own background. I'll kick off with James, with Common Angels, and to give you a bit of background on what Common Angels does, how different structures they're involved with, and sort of generally touching those points and the themes that we've talked today. James, could you kick it off?
Yeah, and sit down.
I will.
You're making me nervous.
I will.
And Dan's tweeting about us. Your photos just went up on Twitter, real time.
Great.
You've all been captured in cyberspace. Is this a good panel?
This is awesome.
Great. Good. Hey, I just got a message. It is. I love it too. So thank you. So yeah, I've been running Common Angels for 10 years. Common Angels started off as an angel group of about 50 folks. We formed our first sidecar fund in 2000. We were one of the first to do that. Common Angels is a hybrid organization. We have not only 2 $10 million funds under management and now 70 members, but we're also members, we're founding members of the Angel Capital Association. We are also members of the U.S. National Venture Capital Association and the New England Venture Capital Association. And that's very important for syndication, which I will come back to in a second. Yes, I was also founding chairman of the Angel Capital Association, which started with 46 groups and now has 145, 146, including 12 dozen here in Canada. So it's a great partnership, and within the Northeast, U.S. and Eastern Canada, we have several Canadian groups that are part of that geographic focus. So we've been running within the Northeast for the past 4 years, a dozen regional syndication summits. The 12th is next Wednesday in Worcester, Massachusetts, and we have been a little bit of a test bed within ACA about how to syndicate deals, and I'll get into some of the negatives, positives, and lessons learned on that in a few minutes. And most of the documents within ACA about how to run syndication summits come from the Northeast and have sort of been through our trial and error process.
So my name's Dan Martell. My home is New Brunswick. I live in San Francisco. I've been there a year. I started off as an entrepreneur in 2004 and built a company called Spheric Technologies out of New Brunswick to about 28 employees, so I sold it last summer. At that point, I wanted to hang out with the big dogs and move down to San Francisco and see what this consumer internet space was all about. So I landed September 1st last year, so come October, things drastically changed. It was interesting because as an investor, I never considered myself a formal angel investor. I just met really smart entrepreneurs and usually invested as part of a way to complement my advisory role. And when I moved down to San Francisco last year, the biggest need come October, November was capital. And Dave was an early mentor to mine, and he introduced me a lot of the early stage seed investors. And that's kind of where I got my footing. So I've done 3 deals in the last year, 7 total in my short career as an angel. I've made a lot of mistakes, and I have a blast doing it. And also an active entrepreneur right now, a company called Flowtown that is building a platform for social media marketing. So I can definitely talk from the entrepreneur's perspective, what I've seen in trends, the differences between raising capital in New Brunswick versus California, the differences that I've seen with early stage and how VCs play a part into that. And really, I'm here to learn just as much as everybody here, so that's my background.
And I'll just touch base a little bit about BDC. BDC is probably a $500 million investment fund, federal crown corporation. stages that we've invested at, I did a little digging as to what the relationship BDC's had over the last little while with angel financing. Approximately 200 angel partners have been involved in our portfolio of about 140 companies over the last 5 or 6 years. So there's sort of a very active relationship with the angel community in those deals, some at a very early stage, some at a later stage as well. BDC invests in a range of technologies from, I'm involved in the software IT space specifically, but we do have a telecom group, a life science group, and a triple EM group, which involves environmental, clean tech types of deals as well. So we've got a spectrum of relationships from the West Coast all the way to the East Coast, deals right across the country, and relationships north-south, certainly on the East Coast, in the Boston community and Silicon Valley as well. So that's a little bit about BDC. Just wanted to sort of touch on, first of all, sort of experience of the panelists on angel-to-angel syndicates and sort of the experience there with that they've had in dealing with some of their earlier investments and how they go about positioning the company from an angel investor perspective, leading into a more institutional round of financing. James?
So John knows I'm going to take exception with the way he phrased the question. It sort of implies a very linear relationship of seed, angel, and then venture. And one of the things that we definitely see in the Boston area, and I think the regional syndication summits, as well as the institutionalization of the angel groups in New England, has really made it clear is that segmentation is much more a matter of strategy than it is of stage. And what I mean by that is that entrepreneurs, angel investors, and venture capitalists in the Boston area today are far better educated, largely in part because of our voice and ACA's voice, about what it means to raise money, sell equity, and what the consequences of that. Large funds in some need large exits. Mm-hmm. Small funds can do better with smaller exits. And individual investors, because they usually are the smaller money in the deal, not always, a $10 or $20 million exit can be well over a 10x return, depending on valuation. So some of this confusion that goes on with saying, well, wait, venture capital, some of them do seed stage, but some don't, and some are later stage, is really kind of a difference of what's the strategy of the company. You're building a big virtualization platform. Please don't see me. I really don't want to have anything to do with you. I can't afford it. I'm going to get killed. Clean tech, a lot of material science. I'm in a drug discovery deal. $10, $20, $30 million to find out if it works is not the game that we're going to play. And it's much, much better for the business development interests of the company to have a deep-pocketed investor really from the beginning. A lot of large firms, and there are a bunch in the Boston area as there are in Silicon Valley, really are abhorrent of market risk. They'll invest very early, but what they will not accept is what is at least perceived at the time to be a small market. Where I think a lot of the confusion comes is that early stage also means a lot of opacity or lack of clarity around how big the market opportunity is. And you kind of sense that over time. There's also data and experience that makes it an easier or more quantitative decision to be able to deploy capital.